How to get a perfect credit score. Number 1, pay your bills on time and don't be afraid to request a waiver if you're late. This probably goes without saying, but the most important factor of your FICO credit score is your payment history. Though FICO keeps its precise scoring formula a closely guarded secret, my FICO reports that about 35% of your score is derived from your payment history. If you have a number of late payments and or collections, your credit score will take a massive loss, costing you massive amounts of money in the long term. Yet, even if you have an occasional late payment, it's often worthwhile to request that your lender forgive a late payment, assuming you've made your payment and are now current on your account. And sometimes, depending on what you're paying for, you could actually be up to 30 days late and it not necessarily affect your credit score. Lenders want you as a long-term customer. It's cheaper for them because they gotta run a whole bunch of marketing to acquire brand new customers. But if you basically ask them hey, can you just forgive this, right? And you make a payment to be current, they'll be much more willing to do that because they actually save money in the long term by doing that for you. Number 2, set up as many automatic payments as possible. One of the best ways to reduce the possibility of a late payment and eliminate the "I forgot" excuse that proliferates throughout the industry is to set up as many automatic payments as possible for your credit accounts. Having your bills automatically deducted from your bank account on a specific date or charged to a credit card, assuming you pay it off monthly, ensures that you're never late on your bills. I've also found that paying bills through your bank online can be a particularly smart way to reduce the chances of being late with your payments. Not only do you avoid running the risk of your payment arriving and processing after the due date if you mail your bills in, but online banking is exceptionally quick and it makes record keeping very easy. And you could easily just do this on your phone too, but obviously don't use a public Wi-Fi. Number 3, don't carry a balance if you don't have to. If you can pay your credit cards off each and every month, one of the greatest misconceptions is that you need to carry a balance on your credit cards to improve your credit score, which just isn't true. As long as you're paying your bill on time each month, even if that bill is paid off in its entirety every month, then you're going to see a long-term positive benefit in your credit score. It also helps keep your aggregate credit utilization down, which comprises about 30% of your FICO credit score. And for instance, you don't actually need a credit card to actually build up a credit score. For instance, if you get a mortgage, you could actually cut up your credit cards because you technically are still having credit on your record. Number 4, don't check your credit score each month. Another somewhat common misconception is that you need to stay on top of your credit score like a leech. Your credit history is akin to a roadmap that lenders use to decide whether to loan you money, and if so, what interest rates you will qualify for. It takes a lot of data points to paint an accurate picture for lenders. This means that your credit score can take a long time to adjust upward, especially given that your length of credit history contributes to about 15% of your FICO credit score. Limit your credit score checks to between 2 and 4 times annually. This will give you a bigger picture to look at your progress. And some bank accounts, some credit card companies actually provide a monthly service for free that shows you your estimated credit score. Number 5, don't be afraid to increase your credit limit. Consumers resist when lenders offer a credit limit increase or they fear asking for a higher credit limit. If you're a compulsive spender, this fear would be justified. In all other cases, I suggest cardholders embrace the idea of higher credit limits. The idea here is simple. The higher your credit limits, the less likely you are to use more than 30% of your aggregate credit, which is the line in the sand point where your credit score could be dinged. Yes, increasing your credit limit will likely involve your lender taking a hard look at your credit report, and it may result in a temporary loss of a few points on your credit score. But over the long term, it could help lower your credit utilization rate, which will have a considerably more positive impact on your credit score as long as you remain responsible with your spending. For instance, as an example, right? Let's say that you have a $1,000 credit card limit right now, right? But you spend, let's say, $300, right, on that credit card every single month, right? Well, that's a pretty decent percentage of your total credit limit. That's why if you were to increase that $1,000 credit limit to a $10,000 credit limit and you still only spend on average $300 per month on that credit card, and you pay it off obviously every single month, you use a far less amount of your utilization, which will increase your credit score. Number 6, ask your lender to lower your interest rate. Though this idea might sound insane, asking your lender for a lower interest rate tends to work more often than not. The thing is, most cardholders don't make this request because they are either afraid to do so or believe they'll be told no. Not to mention, most people are very uncomfortable with simply talking on the phone, and you'd be amazed as to how this is like a really, really big thing. As noted before, lenders spend far more money to bring in new customers than they do by caving in to a few concessions from those with excellent credit score. If you ask for an interest rate reduction, you just might get it, which means lower costs for you and possibly the ability to pay down your debt faster if you're carrying a balance. Worst case scenario, you're told no, and there are far worse things on this planet than that. Number 7, keep good standing accounts open and use them from time to time. One of the bigger errors consumers make is closing good standing credit accounts because they believe credit card companies will view the action as responsible. In other words, consumers believe that by having fewer accounts, they'll be demonstrating to lenders that they can responsibly manage their credit. Unfortunately, that's not how things work. The length of time your credit accounts are open comprises about 15% of your credit score. If your accounts are in good standing, leaving them open for an extended period of time will help your credit score. I suggest making an attempt to use your rarely used good standing accounts once or twice a year to ensure that they stay open and aren't closed by your lender, because sometimes they do end up just closing it automatically. Number 8, only open accounts when it makes financial sense. An important factor in your march toward an 850 FICO credit score is to ensure that you only open new credit accounts when it makes the financial sense to do so. In a given year, I'm offered somewhere in the neighborhood of 30 credit cards, and I haven't opened a new account in years. I just gradually increase my limit. Opening a credit account makes sense when it's an exceptionally large purchase, such as a house or car, or when it's a large purchase that would strain your checking or savings account. In other words, avoid opening multiple new credit accounts just to save a few percent on a t-shirt. Number 9, focus on your revolving debts first. If you happen to carry a balance on your credit cards, it's important for consumers to focus on paying off their revolving debts first. Whether you realize it or not, FICO actually takes the types of debt you pay into account when calculating your score. These two types of debt are revolving and installment. Revolving debts typically have higher interest rates, and your minimum payment is based on the amount you owe. Department store credit cards are a good example. Installment loans are fixed loans of a lengthy time period, such as a mortgage or car loan. Paying down your revolving debts first often means paying less in interest. Number 10, check your credit report annually. Last but certainly not least, make use of the fact that you can check your credit report once annually for free from each of the 3 credit bureaus. Far too many consumers fail to check their credit reports annually, and it's more likely than you probably realize that one or more of the 3 credit reporting bureaus has an error on your report. So you need to go and check them out. And also, like I said, some credit card companies and some bank accounts where you have a credit card at will actually reveal to you your FICO credit score on a monthly basis for free, and they're just listed into your account. For example, I know Bank of America does this where they just show your score for your credit card. Feel free to get a free stock worth up to $500 by joining Robinhood down below. Learn the 4 steps to make money online below. Automate your investing with Acorns, where they just round up your everyday purchases. Create the best landing pages and sales funnels using ClickFunnels. And become a master of your money by going to 40unbox.com. And feel free to check us out on Instagram as well at 40unbox. You feel free to listen to this on the podcast as well. Feel free to watch more episodes about money, making money, personal finance, and so much more. Because this channel is all about dedicating into increasing your knowledge about personal finance. And we will see you in future episodes. Peace out.